All right. Well, for those of you that showed up on time, I thank you, and we'll get rolling. Uh, my name's Chris Carson. I'm a partner at Northern Alliance and a partner at Metro City Property Group. I run the commercial division, and I'm going to have a discussion with you guys today about evaluating income properties. I assume that you've got clients, colleagues, contacts that are interested in investments, even some of you that have done primarily residential. We still have all sorts of people interested in investment properties. So I wanted to bring that up today and speak a little bit about investments, different types, and how we go about evaluating them. Hopefully, you'll pick up um, some tidbits of info to help you be more comfortable with investment type properties. A couple different asset classes that we'll cover. Feel free to stop me at any time. I encourage discussion. And if you have questions or comments or experiences that you want to share, please do. So I'll get right into it. Um, as realtors, we come across this all the time where somebody wants an investment, um, and it's important for us to, in the sales process, to be able to qualify our clients and identify what they're looking for. Not everybody that we come across are savvy investors. A lot of people are getting into real estate investing for the first time when they come to us. Maybe they've made their money in a different industry, but they know that real estate's a great investment because they've researched it, or they just understand. It's very apparent when you look at all the world's wealth. Um, the vast majority of millionaires and billionaires, real estate is a large part of everybody's portfolio. So by nature of, looking at other successful people, knowing that they all hold real estate in their portfolio, we understand, and our these potential clients understand that real estate inherently is a good investment, and we want to be able to qualify who they are, what their appetite is for different investment classes, asset classes, and so we can qualify what it is they could be looking for. So I'll start out by talking about some of the different asset classes, and um, we'll see why I guess some asset classes would, um, I guess, why some investors would gravitate to a specific asset class or another. Again, stop me if you want to, you know, talk further about it. You've got something else to add. I learn as much from these discussions as you do, so chime in anytime. So one of the asset classes that I'll be discussing is multifamily. All of these investment asset classes that I'm going to talk about um, are likely income generating, and that's what we mean as an investment. All the best investments that I'm looking for are income generating assets. And we know that there's a lot of people that can buy a townhouse as an investment, and maybe it's a single family, but I'm really looking towards either multifamily or different commercial asset classes as a true investment. I find that they're much better investments for a number of different reasons. But I'll start out with multifamily. This is generally speaking, 3 units or larger. We always try to encourage investing in as many units under one roof as you can afford. And the reason for that is economies of scale. Rather than having 5 townhouses scattered throughout the city where, you've got tenants in them and you've got 5 sets of roofs to look after, 5 external sets of external windows, 5 different property tax bills and utilities and whatever. 5 units under one roof is going to get you economies of scale and get your clients ahead of the game. You're going to end up with better returns in the long run and pay that asset off faster. So some of the pros for multifamily are stable demand. Obviously, we know that the demand for residential income properties or residential multifamily or apartment buildings it's vast. There's no shortage of uh, renters. They're easier to finance than some of the other commercial asset classes. There's lower vacancy risk. These we know that I see Mark doing some bunny ears, but are you trying to say something, Mark? You're on mute. No. All right. Anyway, some of these they're lower vacancy risks for the multifamily, um, but there are some cons to a multifamily, and we have to make sure that we identify these for our investors and make sure that they're comfortable with the asset and what is involved as a residential landlord. So some of the cons of multifamily are there's strict regulation under the Residential Tenancies Act. This is the biggest difference between the multifamily class in comparison to all the other asset classes that we're going to discuss, which is office, industrial, commercial. Multifamily is the only one that falls under the Residential Tenancies Act, and there is a large difference in the act that it favors the tenant. Um, there, there's a lot of rules and regulations based on residential tenancy in favor of the tenant. One being, it's harder to get them out if they decide to stop paying, or if they're delinquent type tenants, they're causing you problems. It's a lot more difficult to get the tenant out and to dissolve that lease or that contract. So that in itself can be, if you've got even just a few units, let's say you've got a triplex and one of your tenants stops paying, well, 1/3 of your income is now at jeopardy, and the longer that it takes you to resolve a problem, it really shows on your books at the end of the year when you've got a non-payment or um, something to that nature. You feel it a lot more, and it's harder to deal with these issues sometimes. There can be lower upside on rents for residential. We have to. There's a posted rate, obviously, that we can raise the rents every year. Every year, the municipality comes up with a rate that we're allowed to raise rents. Some years it barely covers inflation. Other years it's just a little bit better than that. So um, the rate at which we can increase the rents is a little bit more risky on the multifamily side. There's ways around a lot of different things with multifamily. There's if the building was built after, I can't remember the year, where rent control was put into place, but if they're a newer building, rent control is not quite as strict. Meaning if a tenant moves out, another tenant moving into the building, you can raise it up to market rents. But older buildings have rent control, and even in between tenants, sometimes you have a hard time bringing the rents up to a market rate. There's higher management intensity with multifamily, just by the nature of you having tenants in there, families, all sorts of different problems that can arise with neighbors and the tenants having quiet enjoyment of the property. So they can be a little bit more management intensive. But multifamily still is a great investment if you're willing to go through some of the challenges of dealing with residential tenants. I I did well for a lot of years in multifamily. I built quite a few multifamily buildings, and it is a good asset class, but um, your investor has to understand the pitfalls. As far as I'm concerned, we as realtors are here to educate people on all sides and make sure that they're comfortable with it. If we have if we have a client that purchases something and then has a nightmare experience, they're not going to come back to us. So we want somebody to have a good experience with their investments, and a few years down the road, when the property's increased in value enough for them to maybe pull out some money and go invest in another building, they're coming back to us because they enjoyed the experience. The next asset class that I'm gonna discuss is retail, and I'll kind of quickly go through the rest of them because they're all pretty similar in that retail, office, industrial, and commercial all fall under the Commercial Tenancies Act. And the biggest difference is um, the Commercial Tenancies Act is now geared towards protecting the landlord. There's uh, you've got that key factor of non-payment. If your tenant, you've got a commercial lease in place and your tenant stops paying the rent, the 16th day after non-payment, you can lock the door and effectively dissolve that tenant agreement, dissolve your lease. And um, the process is, you can lock the doors. If they're in arrears, any non-payment that they owe you, you can effectively seize their assets. And there's a process, in order to recover your money. You can seize their assets, appraise them, and start selling them off to recover the money that is owed to you. And this is it's a much more legal process in terms of it's a little bit more black and white when you're not dealing with residential tenants. So it's much more favorable to the landlord for the rest of these asset classes. So retail specifically, some of the pros are you get triple net leases that shift costs to the tenants. In all the rest of commercial, it's instead of legislation, it's much more contract driven. So you have to make these contracts up front to have a triple net lease. Obviously, it has to be written into the lease. Triple net, we describe as something that all of the costs are borne by the tenants, all of the property expenses, like all the expenses, the property management expenses, maintenance, property taxes, any type of external expenses are borne by the tenant. So you've got that shift of cost to the tenant, which takes monthly expenses and payments away from the landlord. You've got potential for strong rental growth in prime locations. So if you've got a commercial lease in a growing, expanding market, and the value of the square footage for the leases is expanding rapidly or increasing, at the end of your lease, you can adjust the cost per square foot to market rates without question. As long as the lease ends and your contract is over, you can find a new tenant or increase the rent to your current tenant to whatever it is that you feel is market, and both parties agree on. There isn't the same type of rent control with residential. So there are some cons in retail at the moment. I would say that there's some market volatility with retail trends. I think there's a stronger movement towards the industrial asset class. Traditional retail is having pressure put on it by um, you know it, online sales, and this is driving businesses to favor industrial properties that they've got a small amount or a medium amount of warehousing that they can push products out online, and they just need a place to import and ship their products or manufacture products or what have you. Um, so there's a trend and some volatility happening in the retail sector, and some vacancy risk in some of the weaker locations. So the prime, even some of the prime locations that we've seen, especially you know through through and after COVID, when there was even grander shift to online sales, people staying home, even some of the better areas, some of the prime streets were, had some vacancy issues with retail. So, um, office as an asset class, some of the pros are you often end up with longer term leases. Professional tenants, businesses tend to turn over less if you've got a professional business and you've vetted them properly at the beginning. You've got less turnover, longer term lease, higher covenant strength, so the businesses back um, the the tenancy agreement or the lease. And typically, obviously a business is going to do everything that they can to stay solvent and pay their bills so that they can remain there. um, some of the cons with office are obviously the post-pandemic vacancy concerns. Pandemic, there's been a large shift to the work at home, and there's a lot of office space that has been struggling, uh, with vacancies since then. Another con is there's often large capital requirements for tenant improvements. As a landlord, you're often pressured or expected to give some tenant incentive, tenant improvement. This is if there's a large cost to move into a 10,000 square foot location, it could cost $100,000 or $200,000 to fit up. And as a landlord, with a longer term lease, you're often pressured to give some money to the tenant in incentive. So the tenant spends $100,000. You give them back after they've spent their money, you give them back $10 to $15 a square foot or something to that effect. So there can be some large upfront costs with owning office space, and that comes with some risk. If a tenant spends money and you have to pull money out of your pocket before the lease starts, obviously it takes time for you to recover that money that was spent on the tenant improvement. And if the tenant happens to go bankrupt before you've recovered all that money, you really haven't made anything with the investment until that's been covered. So generally, larger office spaces as an investment are geared towards larger institutional type buyers that that have deeper pockets, can weather some of these larger investments and wait until the long term for their investments to be realized. Um, the industrial asset class pros right now, industrial asset classes at a very high demand, probably higher than it's ever been, certainly in Ottawa where we're located right now. There can be lower operating costs. Some of these buildings are pretty simple, let's say. If you're building industrial, you're starting out with concrete floors and simple wall structures. So there's yeah, they can have lower operating costs, and again, a lot of those are triple net. The costs are borne by the tenant. So as a landlord, um, your whatever your base rent is often net to you, and the tenants are covering the costs of the expenses. Another pro is that they're very e-commerce driven growth right now. Like I said, there's a lot of businesses that just need a warehouse and with a small amount of office space in the front to gather or whatever, and they can run their businesses out of the warehouse for manufacturing or online sales. So there's a very high demand in the industrial sector right now. Some of the cons of industrial or warehousing are zoning location sensitivity. The industrial properties are often in clusters, and they're not everywhere. You can't put up an industrial office space in the middle of a residential area. The planning departments of all the municipalities keep them separate. So that makes them a little more scarce. And it's the industrial doesn't mix very well with residential. And obviously, I would say the majority of most of our municipalities and cities is residential type sectors. You can have commercial right next to residential, but the zone of industrial inherently has different risks associated with it. In industrial, you can often have more manufacturing type use, or even light industrial with automobiles, and potential for contamination and adverse health risks. So they like to separate the industrial zoning from residential areas, which you know marginalizes them, makes them a little bit more scarce, which increases the value often, or makes them harder to find. Um, Larger parcels can, they're often larger parcels, and that ends up limiting your buyer pool. So these larger industrial type um, properties end up with high values, and it's not as attainable for your average investor that we might come across, that has 50 or 100 or 150, $200,000 of liquid assets in order to invest. Some of the larger industrial plays, these are larger investors. We come across them a bit less, but that doesn't mean we shouldn't focus on them. Just have to qualify the buyer and understand their appetite and their goals. So in talking with a client, obviously you're going to identify whether or not if they're looking for an industrial property or building. Obviously we're looking at budgets, and we can um, you know we can adjust for that. It is a great asset class if they can afford it, but they're often bigger out of pocket dollars. The next asset class that we're going to land on and kind of stay on for the remainder is the commercial asset class. And I'm going to focus specifically on commercial condominiums, because we have an opportunity right now at Metro City to purchase some commercial condominiums. So I'm going to stay on the commercial sector, and we'll come back to the opportunity after we've talked about some pros and cons. The pros for commercial, specifically these condominiums, but commercial is anything. It can be retail. So you could have a plaza, and commercial kind of covers all of these, I would say, the retail, office, and industrial, but specifically commercial condominiums, I want to, focus on as almost their own asset class, because a commercial condo is an individual unit within a larger, commercial complex. And we have some right now that are available that are a great investment, and I want to talk about them. Some of the pros for these are, individual units that we have specifically is a lower entry price point. We've got So the opportunity is our Mattamy Locale commercial investments, and Locale is out in Orleans. Mattamy has done commercial condominiums throughout the city in kind of mixed use developments with some of their other residential above. Um, they did them out in Wateridge in the Rockcliffe area. There's a couple more areas coming to the city into Barrhaven and Canada, where Mattamy's offering these commercial condos that you can buy a single unit and have an investment with a tenant in it for a lower price point. They range right now from 550 square feet roughly to 950 square feet. And this entry level price point puts them into the range for many, many, many different investors. Um, We'll talk about some of the pricing in a minute, but some of the other pros are you've got a diverse tenant base. It's not just, an office that you're looking for a business. These are ground floor retail type opportunities that could be a host of all sorts of different businesses. We've seen lots of dentists, pharmacies, any type of small business can generally operate under these retail type sectors. Not necessarily manufacturing. We're not in an industrial asset space, but restaurants, a host of anything else that would fit in like a retail plaza are available in these buildings. Coffee shops, you know, many different tenants are going to be attracted to these units. There's built-in clientele with the building having residential above, and there's stacked town condominiums all around. So in locale, there's hundreds and hundreds of uh, families and owners and you know residential occupants right on the property. So you've got a clientele that's built in essentially. Um, this, the size brings flexibility to the owner. An owner could, invest. They could use it for themselves. Obviously, if you've got a business that's looking to invest for their own type business, but it can just operate on its own as an investment. You purchase a unit and lease it to whomever. These lease pretty well. We saw that in Wateridge. There's quite a few being absorbed and leased, and there's a vibrant, mixed use community that's happening there. So the cons, I guess I should talk about cons in everything. You know, you have to make an agreement with the tenant. Obviously, the tenant has to live in the condominium, so they have to, abide by the condo rules. And it can be challenging, I guess, dealing with condos. When it comes time to do fit up, and they can be challenging to get a hold of the site plan. Sometimes the condominium corporations might not be quite as organized, but if the landlord knows what they're doing, if you as a landlord know what they're doing and are prudent with the condo board, and you're act as a good liaison and get the tenant started, everybody can have a good experience. And again, it's really the condominium. You have a limited control over some of the widespread decisions that the condo board makes, but ultimately these are designed to operate well, and there's plenty of flexibility built into the condominium board regulations and corporation to facilitate you know good commerce and mix with the residential tenants. So um, we'll I think we'll step into I guess before I show you one of the evaluations of these particular units. I want to talk briefly about how we evaluate all of these different investments, and really we're all of these are dealing with the income approach to value when it comes time to evaluate a property. And what that means is the property's value is inherently based upon its potential to produce income, and what we're really talking about is the net operating income. How much income is how much our income is in relation to the expenses. So we've got our revenues, we subtract our expenses, and we are left with a net operating income. And this net number is really the most key factor when it comes to evaluating any income property. That will drive the property's potential to produce, recurring revenue, and we'll be able to use that number to compare it to other investments. So when we see a net operating income, we can compare that same net operating income to similar properties in similar areas. You know, with residential, we use the direct comparison approach. If you've got a single family home, you're taking three, homes that are very similar in as similar of location and size and price point, with features, and it's a very direct comparison. With the income approach to value and all of these investments, we're doing it similarly. We're trying to take the most comparable property in terms of location and size and asset class and all, similar type factors, but we're also focusing on the income and the net income and its ability to return net dollars. And really that's a driving factor. So if a building is underperforming because you've put a tenant in there at a lower than market rate, the net income is going to be quite a bit lower, and in comparison to other investments in the area, it's going to suffer and it's going to bring the value down. Really, what we end up talking about is capitalization rates. The net income divided by the price is equal to the capitalization rate. So this rate is a ratio between your net income and your asking price. You can evaluate a capitalization rate of an asking price, a sale price, or a theoretical price, but you can use it to forecast the performance of a property that you're about to buy. If I buy a property for $1 million, this is the net income. If I buy it for $1 million, this is the capitalization rate. We compare that capitalization rate to other investments that have been sold recently, in order to try to compare apples to apples as much as possible. The main factor being money return, whether it's an office, industrial, commercial. We can compare investments across the board based on the money that they return and what ends up in the investor's pocket at the end of the day. So this capitalization rate is something we'll talk about obviously when we talk about this commercial condo, but it's important in order to get a feel of the area's capitalization rate. We take sold prices of sold comparables of other properties that we can find, dig into what their net operating income was compared to the price, get their capitalization rate, and we'll start to build a picture of the different capitalization rates in different areas based on different asset classes. So we'll see, if we just look at multifamily, we'll see clusters around the city where there's groups of areas. Let's say we're in Ottawa. I don't know where everybody's from, but in Ottawa we've got some obvious ones that are polarized. We've got Vanier that right now I would say is probably trading around a 6 cap rate, or a 6, above a 6 cap rate. You've got the Glebe that's very expensive type real estate, which brings down the capitalization rate. Glebe could trade anywhere between a 3.5% to 4% capitalization rate, which you might think is a worse investment. But at the end of the day, these better areas like the Glebe appreciate faster. They're more hands-off, carefree investments. They're more passive, and they've got other attractions to invest in that area rather than just a straight capitalization rate, high capitalization rate with higher returns. In higher capitalization rate areas, which are typically, lower value, perhaps lower income, you've got more tenant turnover, you've got higher risks, you've got more management challenges, less appreciation. So there's incentive to buy something with a lower cap rate if you can afford it. But anyways, we use these capitalization rates to evaluate properties, and we like to cluster them. It's hard to evaluate a property that was sold in Vanier and compared to a property that was sold in the Glebe or Westboro. Obviously, like location is very important, and these capitalization rates, you'll see trends. The Westboro is going to trade at a 4 or 4.5 cap rate. You know, I'm generalizing some of these areas to just give you an idea of capitalization rates. I'm sure many of you are aware of them, but anyways, so does anybody have any questions with capitalization rates or anything that we've discussed thus far before I kind of, I guess I want to show you guys the Mattamy opportunity that we have, because it's something that you guys can go out there and sell and talk about with your investors. But does anybody have any questions before we kind of evaluate that further?
Cris?
Yes, Mark.
So
Thanks
just
for stopping me. I just keep talking.
So in other areas like Pembroke, for example, where it's inherently less expensive just because it's in Pembroke, it's not Vanier or the Glebe or whatever. So the cap rate's going to be higher, correct? If
Correct.
the cap rate is higher, it doesn't necessarily mean it's lower quality or lower scores. So I think like how do you like I guess you just got to make a point to say we're comparing apples to apples. It's Pembroke to Pembroke, not Pembroke to Ottawa. I think
You
that's the only
cannot
thing.
you can't compare Pembroke to Ottawa.
Yeah.
Pembroke, we might be able to go purchase a multifamily at an 8 cap, between a 7
Yeah.
and an 8 cap. You can go to Smith Falls, Pembroke, Prescott, and you can purchase something between a 7 and an 8 cap. And if you've got investors that their primary goal is return on investment and positive cash flow. Everybody loves to hear positive cash flow, right? You know, so if you've got investors that they've got $150,000 burning a hole in their pocket and they just want to stick it somewhere and they want to see returns year one, you're gonna have to go outside of the city of Ottawa, because a 4 cap in the Glebe or a 3.5 cap in the Glebe with their minimum down is not going to cover um, the mortgage if they're just putting the minimum down. So you can go out to Pembroke, you can go out to Smith Falls, uh, Winchester, wherever, um, some of these municipalities further away from Ottawa, let's say, and the fundamentals of value apply, right? Pembroke is not Ottawa. It's not Montreal, Toronto. It's not a city center. Value is driven by access and proximity to amenities. And, obviously, Ottawa, a thriving, capital city, inherently has more value than Pembroke. So it just by nature, the, the value of the property is higher in Ottawa, but that doesn't mean that there isn't good rents in Pembroke. There is almost zero vacancy right now in Pembroke. They're starving for property. There's properties being built to house people because there's zero. If you look on CMHC's website, there's zero vacancy. So you can go buy less expensive land and get higher return on investment in Pembroke. Does that mean it's a better investment? Not necessarily. Pembroke's got lower appreciation rates. If you are managing your own asset and you've got to drive an hour and a half to go, cut the grass on your property in Pembroke, obviously there's barriers to entry when you live in Ottawa or you live in a city and you're investing further away. So there's less people that are willing to invest in properties further away, because there's management issues and barriers to entry that, I don't want to drive to Pembroke once a week to go kind of drive past my doorstep on, that I own to kind of check up on things and make sure everything's okay. The management becomes a little bit more difficult. It inherently, we understand that there's risk involved with that. So but by nature of it, if you're willing to own a property further away from you, and yes, you can get better return on investment or annual returns because it's an 8 cap or 7 or 8% capitalization rate. So, but and that's a qualification of the investor. Some of these investors will focus in right away and say, "Hey, I've got $150,000. I need positive cash flow right away because this is all the money I'm investing. I don't want to keep pulling money out of my pocket every month to cover the mortgage." You might have investors in the glebe, or some other asset class that understand, hey, I've, my investment's not covering my costs. I still have to take $3,000 out of my pocket every month, and I'm upside down on my cash flow. But they're playing the longer appreciation game, understanding better area. Even though they're 3,000 a month that they're putting out of their pocket, their property's appreciating by $10,000 a month, and there's a net gain at the end of the day, and there's no headaches, and yeah, they have to keep investing in it, but they've got enough money to do that, and they, big time investors understand appreciation, and they might take that capital loss every year and write it off against something else, and there's some huge gains that can be made by appreciation alone, even though they're not putting income in their pocket every month. So we really have to qualify the investors and understand what their goals are to know where we can put them. If they've just got minimum money down and they need to cash flow right away, we can't put them in an investment property in Westboro because it just won't cover. But we can look at Perth and Smith Falls and Carleton Place and Pembroke and Brockville and Gananoque, these other outlying areas that, just based on the lower value of the real estate, all of a sudden perform better when it comes to returns. So that anyway, that this all is to qualify the individual, and yes, you can have great. I built all my apartment buildings, by the way, in these secondary type markets: Brockville, Prescott, Winchester, Alfred. If any of you know where Alfred is, it's a little bump on the log, on a bump on the road on the way to up the Ottawa River, east of town, and it does very well. Rents are high, property was cheap, and we were able to get good returns building something in a small town, because we took advantage of the cheap real estate. So there's great investments to be had in these other markets. I have a 32 unit in Wendover that can be purchased for a good price, that a client's looking to divest. They purchased it with us a few years back, and they're going to make good money on it already. So yeah, don't discount the secondary markets. But that answer the question, Mark?
Yeah, thanks.
Uh, let's take a look at the Mattamy locale. We'll unpack an investment, and generally speaking, when we're looking at Ottawa, we're talking about Ottawa trading at a 4, 5, 5.5 cap rate for commercial type material. Commercial type investments. We've got, and I'll share my screen here if I can sort this out. Share the right screen here. Everybody see this site plan?
Yep.
This is our Mattamy locale site plan. We've got all these blue or teal type buildings are residential stacks. We've got 3 large buildings that are mixed use. All of them have ground floor commercial, with residential units above. Right now, Block C is almost completed. tenants are going to move in. We're hoping by December. So Matamy's seeing that the building is coming to completion. They want to fill it up, and they're great at giving deals when they want to move property. And right now they've reduced the we've just recently reduced the dollar per square foot for these units to 500. We originally started at $700 a square foot, and right now they're advertising at $500 a square foot, and they'll do even better than that. Right now they're telling us that, they don't want to give us a rock bottom number, but we think that 450 a square foot is achievable. So we're running numbers on 450 as low as 440 a square foot. And I'll show you what that looks like in terms of investment. So this is what I do when I want to evaluate a property. And many of you have seen this, but it's my income investigation tool. It's just a spreadsheet that calculates, like I said before, if we plug in the revenues and we plug in the expenses, it'll give us our net operating income, and then the net operating income in comparison to our asking price will give us a cap rate. So you'll see this particular unit here, and sorry, this isn't, it's kind of dry looking material. It was never designed to be used for the masses. It's just good old fashioned calculating, and so it's a little bit dry looking. I'll often use this client version to give to a client. It just cleans it up a little bit and a little less blocky. But we look here, this particular unit, and they will all perform the same, by the way. There's a bunch of different units that are different square footages, but they will all perform the same because they're based on square footage. Like we've got some units, this is the range of square footages, right from 533 to 940. So this one that we're evaluating is 842 square feet. And what I'm doing is estimating the square footage, the dollar per square foot that we would receive from a tenant if we were the landlord. So we're assuming that an investor is purchasing this unit, and there's a tenant that's going to pay $28 a square foot base rent. And the beauty of a commercial asset class, a retail asset class, again, is that you'll notice that there's no expenses that I've inputted here, because the tenant is the one that takes on all the extra expenses. They're going to cover the property taxes. They're going to cover the condo fees. They're going to cover the utilities. It's effectively a triple net lease where we charge a certain amount for the base rent and square footage, and the tenant takes on all the expenses. So that's in a multifamily type scenario, you'd have your base revenue, your base rent, and then you'd have all these expenses that would offset your rent to come up with a net number. But with these particular investments, the tenant is taking on all the expenses. So you buy a unit, this particular unit I'm evaluating at 440, let's say 450. And I just changed the purchase price per square foot to 450. Let's evaluate it at that. And this 842 square foot unit can be purchased for $378,900. And you just saw that I wrote excluding HST, and we'll talk about that in a minute, because you do have to pay HST above and beyond this purchase price. And some of you will ask me, well, okay, well, is that a true return on investment if you have to add $50,000 to that price, and we'll come back to that in a minute. Well, I guess I'll talk about it now since we're there. If you purchase this particular unit for $378,000, above 378,900, above and beyond that, you'll have to pay 13% in HST, which is 49,257. So an additional $50,000 that you'll have to cover when you purchase it. The reason I'm not factoring it into the cap rate or putting it additionally on the cost right away is because you're going to purchase this unit as a corporation, and this corporation that an investor is going to purchase this with is going to be an HST exempt registrant, meaning whatever HST you end up paying, you can offset the HST that you collect and not have to pay it back. So if I buy this unit for $378,000 and I pay $50,000 worth of HST, as I collect HST from my tenant, I can offset the cost of my HST by not remitting the HST that they pay because I'm an HST exempt registrant. So there's an offset and an HST type exemption or incentive, excuse me, when it comes time to deal with the HST on the purchase. So we are going to recommend every time that a tenant gets advice from their tax accountant to understand the ramifications and calculate what that means for their their returns and their cash flows. But if you look here, this particular this shouldn't have a number in it, investment, okay, at $842 a square foot, renting the square footage for $28 a square foot. I see that Mark has raised his hand. Mark, you have a question?
Yeah, sorry. I think you're kind of getting there, but we were just talking here, like if they're paying rent at whatever you put there, 1950 a month in rent.
$28 a square foot, which is annually 23,576.
Yeah, so like $2,000 a month. That's kind of what I meant. Are you saying like you have to charge? You're saying it's $2,000 a month plus HST, and then whatever that equals, that
Correct.
$200 or $300, and then that's what's taken off on the end when you're exempt from HST. So
I didn't calculate HST here. It's $28 a square foot plus HST. So
yeah,
the tenant is going to pay $28 plus HST, but the tenant's also going to be an HST registrant. So as they collect HST from their business, they're going to offset the HST from what they pay on their base rent anyway. So we calculate this without HST, which is another reason that I'm excluding it in the purchase price. So we calculate these net of HST. And you'll also notice something to mention that debt service is not in this. Okay. So while we're evaluating these investments, we're not talking about, we're in terms of value and cap rates, we're not talking about debt service, meaning your mortgage. We will talk about the mortgage when it comes time for cash flow and return on investment. But when we're calculating value, net operating income, and cap rate, these things all come before a mortgage discussion because the mortgage does not affect the value of a place. Somebody could buy this with 35% down. Another person could buy this asset with complete cash, but it doesn't affect the sale price and value of the asset. It just means that one investor will cash flow more than another. Any of these properties are going to cash flow if you buy them with 100% cash. You can go into the Glebe that's a 3.5 cap rate, and if you buy it with all cash, you're going to put money in your pocket every month because the rents are going to cover the expenses and more. But if you only buy it with, if you buy it with a minimum down, your mortgage is going to eat up your cash flow. So before we talk about value and net and cap rates, we're not, I need to stress that we're not talking about mortgages before that. But we do get into talking about the mortgage when it comes time for monthly cash flow, monthly annual cash flow, and effectively your return on investment. You'll see this last column here, which is a return on an investment at 378,900. Okay. What we're talking about as a down payment is minimum 35% down. Anybody, almost anybody is going to qualify for this mortgage if they have 35% down. Some more qualified investors can put down less than 35%, 30%, maybe even less, but a lot of people are going to qualify for the majority at 35% down. So I'm assuming that we've put $132,000 down on this investment. And this last column is going to calculate our return on investment, our annual return. So a couple factors come into place. Number one, our annual net gains and our cash flow. So after our mortgage, our annual cash flow is calculated every year. What I've done is I've made a couple assumptions here. I've made an assumption that an owner is going to own this for 5 years. I could change this factor to 10 years. I could change it to however many years I want, but right now I'm showing an investor, let's say, that if they own it for 5 years, and there's an annual appreciation, which is a big factor of 5% annual appreciation, which is above inflation, but not abnormal in Ottawa's, history. For the longest time, 25 years, Ottawa had, pretty steady between 4 and 5% annual appreciation. It wasn't until COVID that things started fluctuating a bit here in Ottawa, but we're not Toronto with big ups and downs. We've still got good value here. And I think of the long-term, life expectancy of Ottawa in the market at 5% is a pretty good indication of how it's going to perform for appreciation, especially for a good asset. This is a brand new building that we're talking about here in a condo unit. So 4 or 5% is pretty standard. It could outperform that if the asset class, is well received and you've got good tenants and a good project. So using those appreciation values and the annual net gain or loss that we saw at this one, this property cash flows, by the way. If you put 132 down, which is your minimum 35%, annually, your cash flows over $4,000. Anything that's break even or better is often a win for most investors. They don't have to pull more money out of their pocket every month. But we're seeing that, with this annual appreciation, every year, their annual return on their initial investment is 17.5%. So I don't know of any, stable investments that aren't in real estate that can outperform that. You're annually getting 17.5% on your initial down payment. Like I said, we're not talking about the HST there. There's going to be a little bit more of a calculation that they're, $50,000 off of this number, but they end up getting it back. So it's not a straight return. You end up getting that back. There's a little bit more of a complex calculation, but generally speaking, dollars to dollars, your annual return on investment in this is looking at the 17.5 mark. Now
Hey,
you
Chris.
can out. Yeah,
Sorry.
go ahead.
I think Mark and T are gone too. Mark's Danny's training's on now.
Yeah, no worries. I kind of I outlived my stay a little bit here, but yeah, you're right. but this is being recorded, so anybody, I'll encourage them to come back and kind of wrap up. But for those of you that stayed, I know Liam wanted to see these investments too. I was talking about them, and yeah, this is coming into viable investment territory for people now, and with the low barriers of entry, you know, and a relatively lower down payment when it comes time to an investment, these are getting into viable investments now. You know, we come across quite a few people with $100,000 or $150,000 to invest, and I think that these are good investments. I've been, you know, Kevin, you and I were talking last night about, you know, how do we kind of think outside the box and get these investors, you know, go attract some people to lease, and I've been thinking about it. I have some good ideas, and we've got people that we know that want to lease these things. And
Yeah,
there's
no, I
upside
definitely
to
think
it.
there's, like I said, to make especially these prices, it's, I mean, I'm not saying no brainer. I don't know enough about the market, but it seems quite safe. You know, the worst case, like you said, you might not make as much, but you're not losing, which is always good.
You'll find that there isn't many 6+% cap rates as commercial investments in the city, especially not for a brand new asset. You know, as assets depreciate and over time they you know, they degrade. There's money in deferred maintenance to be spent on them. You know, an older building, you might, you know, in an older area, you might come across some of these, but it might be a plaza that is got a sticker price of $1.5 million, and you need, you know, three, four, $500,000 out of pocket to put down, and you know, you're limiting your buyer pool. There's a lot more people that we're going to find that this works for than the average property in the city, and we've got access to them. So
And also with brand new, right? It's a brand new building.
that's what I
You're not
mean.
worried
It's
about the roof. You're not worried about, you got a wall, so you have to worry
exactly
about anything serious, hopefully. So
ever really, because the condo fees are being paid for the deferred maintenance on the roof and the windows, and you know, the building's envelope. So you know, it's a pretty risk-free type investment, knowing that you get a brand new building, and if you've got a 10 or 15-year acquisition criteria, you're not going to have any surprises. You know, maybe there's some weird special assessment that increases your condo fees by a bit, and at the end of the day, you're going to pass those fees on to a tenant, because they're you know, you're going to try to get a um, you're going to try to get a lease that the tenant pays your condo fees.
all right, well, I'm gonna jump on the other one.
All
Thank you,
right.
sir.
Sorry for going over the time.
Oh,
Thanks
okay. I just
for
want you to realize that theirs dropped off, just so you didn't think they all just left you.
yeah, all good. I'll encourage anybody to come and take a peek at this video afterwards. So thanks for sticking around.
I'll talk to you later.
Enjoy.
Bye.